market pharmaceutical stocks such as Alchem, Zydus Life, as well as Alembic, which are buzzing on the back of their numbers, not to mention even something like a JB Chemicals. Alembic Pharmaceuticals is the one that we're talking about. It's in focus after it reported what was a mixed set of Q2 FY24 numbers. Revenues were marginally better than estimates, but the margins and profit came in lower than estimates. The India business growth witnessed a slowdown, while the US business growth was in single digits, came in at around $53 million for the quarter. To discuss this and more, we have Pranav Amin, who is the Managing Director, Alembic Pharmaceuticals, joining in. Pranav, hi, welcome to the show. This is Ekta on the side. Just wanted to start with the US markets, because you've seen $53 million in terms of sales this quarter. This compares to $47 million in the previous quarter. Just wanted to understand what was the impact of the drug shortages, price pressure, and what are you guiding for in terms of a quarterly run rate now?
So yeah, in terms of absolute rupee amount, we grew about 6% in the US business. So that's pretty good. As you know, we've seen a lot of pricing erosion. I think we're seeing that stabilize to a certain extent. What is more interesting is we've got these new facilities that are coming up on stream. So we did launch some injectables from some of these from both these facilities. It's early days, and we're still a good reputed supply partner. So we're seeing opportunities in the US. Volume growth is over 7% or so.
Okay, Pranav, in that case, since you are talking about good demand coming in and the shortages or price erosion stabilizing as well, what can you guide for in terms of US sales going forward? And one of the concerns that analysts have is that there are no visible launches that are coming up. Can you apprise us of the pipeline as well?
Yeah, so we don't share the pipeline that's coming up, but we are going to be launching about 15 to 20 products this year. We've launched 6 plus 2, so 8 or 9 products already. In the first half of the year, we'll launch another 9-10 products in the second half of the year. In terms of the kind of launches, we've got a few injectable ones, we've got ophthalmic, derm, and of course the old OSD products. That's what they're seeing in the market.
Okay. Now, just coming to the US sales, what is the quarterly run rate that we can expect? What is the range that you can share with us? Is it going to now be above $50 million? Because the last time you did that was in Q3 of FY22. So what is the quarterly run rate? And, a couple of quarters ago, you had cut your guidance for the US sales to $300 million versus $500 million. Now, on an absolute basis for the fiscal, where does it stand?
So actually, the $500 million was never a guidance. It was just someone had asked me, where could we see this business going with the kind of investments and the way the market was a couple of years back. So we had guided it could be $300-400 million. So there's no guidance per se. I think what we saw in the last 2 years is there's been a drastic amount of price erosion from where we were, which took down a lot of our margins and the US revenue. You know, you're right, we were ahead of 50 million, we're back to about 50 million. Moving forward, we'll keep building upon this on this base business as we keep launching. As I mentioned, we're going to be launching about 20 products this year. So we'll keep adding to that as we go along.
Okay, so that's about the US business. Let's talk about the domestic markets. Grew only 5% versus expectations of around 8 to 9% growth. What was the impact of slowdown in the acute drugs this time, this quarter for the company versus the industry as well? And what can you guide in terms of growth going forward, specifically in the domestic portfolio?
Yeah, so domestic is an area that we've really been focusing on, and we have a much higher promotional spend in the domestic industry, in the domestic business. The acute was the one that dragged it down. Acute, we grew only about 5%. As you know, the entire acute segment was slow, as you may have seen across the board. What is heartening, though, is on the specialty side of our other business, we grew at about market representation of about 10%. So that's been good. In the domestic side, another area we've been focusing on is the veterinary business, and that grew almost 32%. So that's been quite interesting as well.
Oh, okay. So your veterinary business grew around, what, 32% you mentioned?
32%, yeah.
Okay, interesting. The disappointment was also the margins this time. The street was anticipating 16%, Pranav. You came in at around, I think, 13%. What led to the margins, contracting or maybe being flat on a Q-on-Q basis, rather? And what can we work with going forward in terms of guidance?
Yeah. So it's a good question. Actually, we see on a Y-on-Y basis, one of the reasons for the reduced margins is from this year, we've started expensing all the new facilities, right? So we've got 3 new facilities, and they're all getting expensed. Earlier, they were getting capitalized. So that's about 4% right there. You're talking about 60, 70 odd crores that's hitting the P&L right away, because these facilities are still in the nascent stage. and it'll take a couple of quarters till they ramp up to a decent amount of capacity. So that's one thing that has led to the margin. And second is, as I mentioned earlier, that we had a high promotional spend in the industry. So both these put together would be about 4% odd. So hence, margin-wise, we're better than last year, but it's just that with this additional expense that has come now, and that's dragged it down.
Okay. Your aspirational margins at one point in time were 20%. How far away is that target for you?
I think at that point of time, the market was very different. The US generic business was extremely different from what we're seeing today. So we've not given a guidance. I think right now we're happy with the 14 to 16% margins that we have. And few things we said that we'll do, right? So we said we'll cut down our R&D costs, which has come down from about 13, 14% to this quarter about 8%. In absolute terms, this year we'll do about 500 crores of R&D. So that's coming down. That'll lead to a little bit of a margin improvement as the new facilities start getting and throwing out more product and better utilizations. That'll also lead to a margin increase.
Okay. Last question before we let you go, Pranav. You're talking about capex. You're talking about new launches coming in as well. What is the debt picture looking like in that case? 600 crores currently. By the end of the year and next year, what would it look like?
So the absolute debt, I think, with debt to equity wise, with the same as we were last year's 0.14. I think we've seen a marginal increase this quarter. Of course, we have the dividend payout as that happens. But apart from that, over a period of time, debt should come down because we're not doing any major large capexes. It'll be mainly maintenance and smaller capexes. So debt will come down. I think another 2 years, we should be close to zero debt.
Oh, okay. All right, Pranav, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that is the management of Alembic talking about their numbers. They are expecting margins to probably be in a range of around 14 to 16%. They're expecting debt reduction to probably take place, and they are seeing price erosion stabilize in the US markets. That's stock down around 1.5%. We'll take a short break, but on